Our next guest says dump tech here and buy value. Let's welcome Joe Zidle, Blackstone's investment strategist. Joe, welcome to the desk.
Thanks for having me.
How do you feel about technology at this point where we have narrow leadership? What are the valuations like in your view?
Valuations in tech are getting stretched. You know, if you look at the 15-year average valuation for tech, they're about 1.25 times that. There's other cyclical sectors out there like energy, materials, and industrials that have just as much sensitivity to profits, just as much sensitivity to, growth in the United States that are trading at lower valuations. So the reason why you want cyclicals in this environment is because when profits are expanding, you get that exposure, you're tied to that profits growth. But of all the cyclical sectors out there, discretionary and tech are the two most expensive.
I'm glad you mentioned those two in particular because these are the two sectors that arguably could feel the most pain if we have another round of tariffs imposed, at least on the consumer side, right? Prices will probably go up because it's such a broad swath of products that the tariffs would hit. These are also the sectors that haven't taken a discount for tariffs. And so does that factor in? I mean, would you anticipate that a hit to these sectors could actually be deeper than a hit that we've seen elsewhere?
I'd say a couple things. Number one, the tariffs, trade war with China is not going away anytime soon. I don't know if it's necessarily going to slow growth, but I think the more practical implications is it's going to cause higher input prices, right? You don't have a lot of CEOs talking about trade wars, but you have a lot of CEOs talking about input prices. The two are one and the same issue. So I think for discretionary tech, that could be a problem. But across the board, I think we have to expect higher and higher input prices, whether it be through tariffs or higher oil and gas or tight labor markets, et cetera. Now, the good news for equities is the beginning portions of inflation are actually very good for stocks, especially those cyclicals, because they have the ability to grow their businesses, their revenues, their sales, et cetera. As inflation takes more and more hold, though, it starts to become problematic. But for right now, I think the inflationary story, especially from sort of the trade war itself, is not inherently bad news for equities. The thing I'd worry about is the fixed income side of a portfolio, right? Because it's gotten such massive inflows since this bull market started in 2009. It's like people have not embraced equities. They've gone full on into traditional fixed income. And that's, I think, a little bit more problematic.
Do you think, though, that when we think about this trade war, because obviously on the desk here, some of us believe that we think that we can kind of hold out a bit here and China can hold out a bit here. But when you think about manufacturing, think about supply chains, it's not so easy to change 30, 40 years of this. And so when you see the president tweeting at Apple saying, build your iPhones here, that would take decades to really do in the capacity that we're talking about right now. Yeah. So is that a fundamental problem about this? We really are not going to be able to fix that.
You really nail an important issue, and that is this is a game of chess. This is not simply just like, hey, here's tariffs on $200 billion, and then they put on tariffs against, $100 billion, whatever, and you sit back, you add them all up, and you say, oh, it's not that bad. We're a $17 trillion economy. What people miss in trying to add up the damage that tariffs have done is that this is a global interconnected supply chain with a lot of knock-on effects. And I think from that perspective, we need to consider this to be a game of chess, and it's going to have tremendous knock-on implications that are really difficult for companies to forecast and adapt to. I think all in all, the thing you have to be prepared for is disruptions to that supply chain. It will probably drive CapEx, right, and probably drive CapEx onshore because companies are going to want to try to protect their infrastructure, their supply chains, et cetera. So, I mean, there could be a bullish story or a silver lining to companies from that perspective, but I think it's going to make it harder and harder for companies to plan.
So, Joseph, I wanted to go back to the fixed income part of the people's portfolio because we're hearing that there's input cost pressure. But on the fixed income side, we're not seeing it in bonds. Inflation index bonds aren't really showing any future inflation at wherever. So what happens to your portfolio or the equity side of your call if we don't get that inflation?
Yeah, well, here's the thing. June of 2016, I think, was like the end of this 34-year bond bull market, right? That's when the 10-year Treasury yield hit 1.35%. Today, it's sitting close to 3%. Over that time, investors put something like they pulled about $137 billion out of U.S. equity mutual fund and ETFs combined and put over $600 billion into fixed income. Over that same time period, the S&P 500 is up 45%. The Bloomberg Barclays Aggregate Bond Index is up 10 basis points. So in other words, investors have gone full on in fixed income at a point when we're in a bear market for bonds. They are thinking perhaps there's no inflation, or perhaps they're stuck with this lower for longer mentality, or perhaps it's the recency bias where they take what happened in the recent past, the great financial crisis, and say it's going to happen again. Either way, they've gone full on into traditional fixed income. And if you look at where those flows went, they went intermediate duration. That's a problem when inflation starts to rise, because we've got to think about What's going to happen? What's the investment world going to look like when the 10-year Treasury hits 3.25% or 3.5%? And it means investors are going to take losses in a fixed income that they haven't taken since prior to 1982.